In this video, I'm going to reveal to you a profitable strategy for volatility 75 index. Okay, whether you're a beginner trader or you're a pro trader, this strategy will help you make profits. Now, we are going to be using just one indicator. Okay, just one indicator, and also I will show you when to buy or when to sell. Okay, and also I will show you when to take profit and where to also have your stop loss place. Okay, and lastly, I also recommend the lot sizes you can use for any particular account size you decide to use to trade. If you decide to trade with a $100 account, or you decide to trade with a $50 or $200 account, I'll be recommending the lot sizes you'll be using to trade this strategy. So quickly, let us set up the indicator that we are going to be using for this strategy. So go to your indicators windows, okay, or you click on this F icon here to be in your screen. Click on the F icon. Okay, then these are the indicators that we are going to be using. Okay, we are going to be using the relative strength index. So let me just quickly delete everything so we can do it together. As you can see, my chart is plain, so let me just go. Let's click on the F icon. Okay, and let's look for relative strength index. So we have it here. This is the relative strength index. So you click on it, okay, and use the default settings. Your period is 12. Not default settings. You use this particular settings. Your period is 14. Apply to weighted close, HLC4. Okay, then your levels is only 50. Your level is only 50. Okay, then your style, you're using 2 pixels. Okay, and if you're using a white background, just use color white, then you click done. Okay, so now we have the RSI window here in the chart. So now let's add just one more indicator to the RSI. So you click here, you click on this indicator window one, this plus sign here. You don't go to this main. This is the one that we're going to be using. Okay, so you click there, then you look for Williams percentage. Okay, Williams percentage. So this is our Williams percentage. Okay, so you click on it. Okay, and you'll be using the default settings. The period is 14, levels is -80, -20. Then your style, okay, you can use 1 pixel or 2 pixel, or then your color, you can use any color that is suitable for you. Okay, we can decide to use this color now. Let's just change the color to this one. Okay, it's something a little bit brighter. Okay, so this is the color we are going to be using. Now this is what we have here. Okay, so how do you trade this strategy? Okay, the very first thing I want you to know, okay, that when you are trading this with this strategy, the market conditions we are looking for to trade with is trending market. We are only looking for trending market. Okay, we're looking for when the market is in a trending condition. Okay, trending condition means the market is continuously buying. Though in trading conditions, we are also going to have pullbacks. Okay, pullbacks before the market continues selling. Okay, but when the market is ranging, the market is trapped in a fixed price. The market does not break above that range or break below the range. It's just trapped in a fixed price. So we are not looking for ranging conditions. We are not trading ranging conditions in volatility 75. We are only looking for trending conditions in the market before we trade. Okay, so how do you trade this strategy? We are going to be using supply and demand zone, okay, to trade this strategy. Do you hear me? I said we are going to be using supply and demand zone. The reason why I don't want to call it support and resistance is because they are almost the same thing. But support and resistance zone can also be diagonal. Okay, it can also be diagonal. Okay, but supply and demand zone is only horizontal. So you're only looking for horizontal levels, horizontal support and resistance levels. You can also call them supply and demand zone. Okay, so those are the levels that are looking at trading off from. Okay, so how does it work? Now, when the market is in a trending condition, you have to now identify what the market is doing. As the market is in a trending condition, is the market trending downwards, even if it is pulling back, but is it trending downwards? As you can see here, the market is, from price action, the market is obviously trending downwards. Okay, Now these pullbacks is what gives us opportunities to buy or to join this trade, to sell this market. These pullbacks that happens here is what gives us opportunity to join this selling market, and also what gives other traders opportunity to sell the market. Now where do you now buy and where do you now sell from? So this can be called a demand zone because price came back to mitigate this level here. It came back to mitigate this level here. Okay, came back to mitigate this level and continue selling down back and downwards. Okay, and also when price got here, also they also came back to when it broke downwards, when it broke this zone. Let me just show it to you. Okay, when price broke this zone also downwards, he also did what? Pulled back to this demand zone. Okay, he pulled back to this demand zone, to this demand zone before he started selling. Sorry, let me just get that. I need to show you so you see it in your eyes. Then when you're in the market, you can also identify it. So the market pulled back to this supply zone, rather not demand, pulled back to this supply zone before continue selling again, and it broke this next low. Okay, it broke this next low. Remember I told you I'm going to be showing you where to take profits and when to take stop loss, but we are going to be taking it one after the other. So after price broke that zone, it still pulled back immediately and came back to this next supply zone before started selling again. Okay, can you see that price respected this zone? Price respected this high. Price did not take out that high. Also here, this high that was formed here, price respected that high, did not take out that high. This is what confirms to you that this market is actually in a downtrend, and you should be only looking at selling the market, because at the end of the day the market will still come back, and the market will still pull back, but it's not break, it's not take out the last high before continue selling. Okay, and here also the market did not really give us much trading opportunity. Okay, the market was sold expressly. Okay, but when the market got to this zone, it now pulled back, it now came back to this supply zone again. Can you see how price mitigated this zone? It came and mitigated the zone here and started selling again. Okay, when the market sold again, because now the market is now in a high, in a very, very trending condition, the market still continues selling. But see again, when the market pulled back again, it now still came back to this same supply zone. When it came back to that zone, before it now started selling downwards again, and broke the next level. Okay, it broke this next level. Can you see here? Okay, now when do you now take profits, and when do you now place your stop loss? Okay, very, very simple. Where do you take profit and where do you place your stop loss? Okay, so when you're selling this market, okay, this is the first zone. Let me just mark it so we can see very well. Okay, I'm just mark out this zone. Okay, so let me also mark out this zone, because we need to get everything right. Okay, we need to take profit at the proper zone and also have our stop loss placed at the proper zone. So now when you are selling this market, as soon as the market breaks any low like this low, if you sold from here, from this zone, that's when price got to this supply zone, supply block. When price came to this supply zone and started selling, this will be your stop loss. Your stop loss will be above here, just above the supply block, or at this extreme. But to preserve capital here, this will be our stop loss, just above this supply block. Okay, and price came and mitigated that block. You don't even get to 50% of that zone, but sometimes it gets to 50% before you now started selling. So as soon as price comes to this zone, as soon as price breaks this particular zone, as soon as price breaks this zone here, this one, as soon as price takes out that low, this move that took out this low, you take your profit. take your profit. You don't care about the remaining move that happened below this low. This particular move here is not your concern. You don't care about this move. But as soon as price takes out this low here, as soon as price takes out that particular low, this one here, as soon as price takes it out, you take your profit. Okay, and you now wait for price to return to supply zone again, which price did here. Okay, price returned to the supply zone. Okay, so as soon as price returns to the supply zone, you take another sell trade and you take your profit as soon as price takes out this next low. This is the next low that price formed. After price broke this low, this was the next low that price formed. Okay, guys, please hope you can see where I'm showing you. This was the next low that after price took out this low, this was the next low that price formed. Okay, and as you can see here, immediately price took out this low, it pulled back again. Can you see? It pulled back again. If you are waiting for price to continue selling, you would have been in a loss. Okay, so to give you maximum to give you optimal maximum trade opportunities, always ensure you take your profit immediately price comes below the previous low that was formed, because the market is in a bearish condition. So the market will continue taking out lows, but it will not be taking out high. It has not been taking out highs. This high was not taken out. This high here was not taken out. This one was not taken out. This high is still intact. This high is still intact. This one also. Price did not take out all these highs, okay, because the market is in a bearish condition. Okay, the market is in a bearish condition. Now, how do you also use the indicators? How do you use the trading indicators? Okay, the RSI we have here. The RSI is just another confirmation. So as soon as you now confirm that the market is in a trending condition, whether it is buying or it is selling, as soon as you confirm that the market is in a trending condition, you look at this RSI and you don't buy or sell except the market has crossed the 50 level in the RSI. If the market has not crossed the 50 level in the RSI, you are not taking any trade. You have to always wait for price to come above the 50 level, this 50 level here, this one here. As soon as price comes above this 50 level, you can now start looking for buying or selling opportunities. If you are trying to sell the market, price has to come above the 50 level and come as if it's coming towards this 100. Then you now look at price. You now look at price and look for demand zones. Okay, supply zones that you can now use as a very, very good confluence to now sell from, and that's where you now have your stop loss. You cannot get your stop loss from just looking at this RSI. You can only get your stop loss by looking at price, by looking at what price is doing. So in as much as this RSI is important, this price movement, what the market is printing, is also more important, and it should also always take note of what the market is doing before you start buying or selling. All right, so now in buying conditions, you do the exact same thing. Okay, in buying conditions, you do the exact same thing. You wait for price. In buying conditions, it will be like this. Okay, I get to buy, return back, pull back to a support zone. Okay, and the support zone will now pull back to a support zone before support, previous support, and I'll now turn to resistance to now buy upwards. Okay, the market will continue doing this kind of price actions, but it will not be taking out the previous lows. Okay, that's how price delivers. That's how the market delivers price in bullish conditions. Okay, that's how the market delivers price in bullish conditions. Then you now wait for price to come to your demand zone. Okay, when price comes to your demand zone, in this case, when the market is bullish, the market comes to demand zone, and when it's bearish, it comes to supply zones. So when the market pulls back to demand zone, the demand zone will always be within this range here. Okay, when it pulls back to demand zone, you now buy again, and you have your stop loss just below here. Okay, then as soon as it takes out the high here, you take your profit. Okay, so now what type of lot size would I recommend for various trading accounts? Okay, you know now this is volatility 75 and the market is very, very volatile. So for $100 account, for a 100 USD account, and you can open two positions, okay, two positions. All right, then on a $200 account, on a 200 US dollar account, you can you can open up to 3 or 4 positions using the minimum lot size, which is 0.001 on volatility 75. Then if you are trading small accounts such as $50, if you are trading a $50 account, the recommended lot size you should be using is 0.001, and don't open more than one position. Okay, don't open more than one position. All right guys, thank you for watching this video. See you in the next video. And if you also want to join our VIP group, our signal group, okay, we have a signal group. If you want to join our signal group, send me a message on WhatsApp and I will add you to our signal group. Okay guys, thank you for watching this video. Don't forget to like, don't forget to subscribe, don't forget to share this video with friends.